And the next topic that we're going to cover, it is the option Greeks. Then you might ask yourself, what are Greeks? In short, the Greeks are derived from a mathematical model called the Black-Scholes, in other words, the Merton BSM Black-Scholes model, which it is widely used for pricing an option contract. Based on the model, the price of a call option is determined by the next topic that we're going to cover in this course, which are option factors that influence option price, and traders refer to the terms known as option Greek. These include delta, gamma, theta, vega, and rho. The Greeks are measures of the individual risk associated with trading options, as well as providing us a quantifiable means to measure an option price sensitivity to the factors that influence them. The Greeks are utilized in the analysis of a portfolio and its sensitivity to price. The measures are considered to be essentials by many investors for making informed decisions when it comes to trading options. The Greeks also tell us how much a price is expected to change in relation to the changes in certain variables such as the underlying stock price, the underlying strike price, the underlying volatility, and of course, time. The first option Greek that we're going to cover, it is delta. Option delta measures the rate of change of the option price with respect to changes in the underlying asset price. Delta is the amount an option price is expected to move based on a $1 change in the underlying stock. Call options have a positive delta between 0 and 1. A quick way to remember that it is call price rise when the stock price increase. Call price falls when the stock price decrease. Here is a quick example. Let's say a call option contract has the following parameters. The stock price, $25. The option price, $1, the call delta, 0.5, and the stock goes up by $1. If the stock price goes up by $1, in theory, the price of a call option will go up about 50 cents. So in this case, the option goes from $1 all the way up to 150. But on the other hand, if the stock go down by $1, in theory, the option price of the call option will go down by 50 cents. So in this case, decreasing from $1 all the way down to 50 cents. Put options have negative deltas between 0 and 1. A quick way to remember that is put price increase when the stock price decrease, and of course that's due to the increase in volatility, and put price falls when the stock price increase. That's also due to volatility decreasing. Let's look now in a put contract example. Let's say that this trade has the following parameters. Stock price $25, put price it is at $1, the delta minus 0.5, and the stock goes up by $1. So in this case, if the stock price goes up by $1, in theory, the price of the put option will go down by 50 cents. In this example, dropping from $1 all the way down to 50 cents. On the other hand, if the stock goes down by $1, in theory, the price of the put option will go up by 50 cents. In this example, increasing from $1 all the way up to $1.50. Another way to look into delta is the probability of a particular option to be in the money. In this example, using the ticker symbol NCLH, the $14 strike price has a delta of 42. So therefore, the option has a probability of be traded in the money 42%. Let's go back to TastyWorks platform so I can show you guys a free example of deltas. Okay, so let's say, for example, we're gonna pick a strike price here with a DTE of 49 days to expiration. If you open the option chain here, if we say, for example, we are bullish or mild bearish, or you're going to think that the stock is going to trade sideways, we're going to come all the way down here. You're going to sell, let's say, a 37 delta. So we're going to sell here a put option of 561 strike price, and you're going to collect a premium here of roughly $8.20 something. So in this case here, our trade here has a probability to be trading the money 37%. In other words, our trade has a probability of profit of roughly 63%. So if you delete this, for example, if you go down here, if you press here the mid price, as you guys can see, roughly 69. But this is pretty much what it is if you were to pick a delta of 41. So this is our probability. So basically, it's 1 minus the delta. This is the probability of the trade to be trading out of the money for put sellers. Now back to our presentation. Option delta is the best way to help us option traders to make informed decisions on what option to trade, especially when it comes to sell options, as a delta will tell us the probability of the option ending up in the money or out of the money at the expiration date. The second option Greek that we're going to study, it is the option Greek gamma. And as we discussed previously, that the delta is the change in the option price or premium due to the change in the underlying price. Now we will discuss how delta itself changes with the change in the underlying price. This is known as gamma. And gamma measures the rate of change in delta with respect to change in the underlying price. Think of gamma as a delta of the delta. One of the main reasons we are studying the options Greek gamma after we learn about the option Greek delta is basically because gamma is a derivative of delta, and gamma estimates the change in an option delta with $1 change in the underlying price. Gamma values are highest at the money and lowest for those deep in the money or deeper out of the money. At the money options have the highest gamma, as you guys can see in these two images, because the deltas are the most sensitive to underlying price changes, and as the underlying moves away from the strike price, the gamma decrease, as we can see here in these two images. As the underlying moves toward the strike price, the gamma also start to increase again. One thing is to remember that option buyers have a positive gamma effect and option sellers has a negative gamma effect. And as we learned during option variables, studying option moneyness only in the money options has intrinsic value at the expiration date. The best way to visualize gamma change is to see how it works, is to go through a visual example. Let's say that our option trading contract has the following parameters: stock price $25, option type call option, delta 0.5 and gamma 0.05. It means for each $1 increase in the underlying secured price, the delta will change from 0.5 all the way up to 0.55. But if the stock go down by $1, in theory, the price of the call option will go down by 0.05. In this case, going down from 0.5 down to 0.45. To finish with the Greek gamma, we just need to remember that gamma is the rate of change of an option delta. Gamma risk grows close to option expiration date, and gamma tells us the instability and stability of an option profitability. The third option Greek that we're going to study in this option trading course for beginning, it is the option Greek theta. Theta measures the rate of time decay in the value of an option or its premium. Time decay represents the erosion of an option value or price with a passage of 1 day or else being equal. One thing to remember is that option buyers have a negative effect due to option decay, and option seller will have a positive impact also due to time decay. When looking at the option with 45 days to expiration, one thing to note is that the biggest EV, extrinsic value, is going to be in option trading at the money, because most of other money options extrinsic value is made up volatility and time, and the other money options will have the greatest chance of becoming both valuable and not being valuable. Consequently, when you look further out of the money options, there's going to be less EV, extrinsic value, and less probability of being in the money or out of the money. So there's going to be that slope, as we can see in the picture. So the options trading in the money has the highest EV, and options trading out of the money here on the end of the curve has less EV. And if you compare at the 45 DT option with the 5 DT option, the 5 DT options will be cheaper as the option has less time to become profitable. Options are the key asset, and as time passes, the option gets closer to expiration date, the options lose the extrinsic value slowly. And the option Greek theta help us to understand how much the options are expected to lose the value each day. For us option traders and option sellers, that is one of the most important Greek with delta, as it tells us how much the price of an option should decrease as the option gets close to expiration date, and it's also known as a time decay. In simple terms, time decay represents the erosion of an option value or price due to the passage of time. As time passes or goes by, the chance of an option being profitable or in the money lessens. Time decay tends to accelerate as an option gets close to expiration date because there's less time left to earn a profit from the trade. One very crucial and important thing to remember, especially if you're going to be an option seller like myself, is that option decay differently depending on whether they are at the money or out of the money. At the money options decay exponentially, with the rate of decay accelerating as it approaches expiration date. Most of the decay happens in the last 21 days. Out of the money options have inverse decay curve. Example, they lose most of the value prior to the 21-day mark, and the rate of decay decrease in the last 21 days. If you look at this picture, we can notice that for both call and put options, all the theta values are negative. And that's because all options lose their extrinsic value as time passes and goes by, and as they approach their respective expiration dates. Therefore, when we check the option chain, theta will always show us a negative sign. In this example, if we buy the $165 strike price with a theta decay of minus 9.0 something, what theta tell us? For each day the time passed, the option will be losing $9.062. But because of passage of time or time decay, the minus $9.062 value will change each day and increase rapidly once the option gets close to expiration date. The next option Greek that we're going to study, it is Vega. Vega measures the sensitivity to volatility. It measures how much the price of an option change based on a 1% change in the volatility of the underlying security. In simple terms, Vega is the amount of call and put option price will change in theory for the corresponding 1-point change in implied volatility. Vega also measures the risk of change in implied volatility or the forward-looking expected volatility of the underlying asset price. While Delta measures actual price change, Vega is focused on the change in expectation for future volatility. Higher volatility makes options more expensive since there's a greater likelihood of a stock price having a greater move and hitting the strike price at some point in the life of the option contract. Vega has positive effect on option buyers and Vega has negative effect on option sellers. When we are long options, we have a positive Vega. However, when we write option contract, we as option sellers, when we write a contract, we have an effectively negative Vega. If we compare two call options that belong to two different stocks currently trading at $75 per share, we will be able to see which stock is expected to move more based on the option implied volatility value. In addition to the underlying price for both stocks being trading at the same price and expiring at the same day with the same $75 strike price and delta values. Yet, the option on stock B will be more expensive. This is because the option on stock B has a higher volatility. And as we have learned in previous lectures, the extrinsic value is the portion of an option premium that are affected by the risk factors such as time, interest rate, and of course, implied volatility. For example, let's say that we have a 30 DTE on option on stock XYZ with a $50 strike price, and the stock is currently trading also at $50 per share, and the Vega for this option is 0.03. Therefore, the value of the option might go up or down by 0.03 if implied volatility increase or decrease. Therefore, option sellers will benefit from a fall in implied volatility, and of course, this is the opposite for option buyers. Vega is a strong contributor to option price movement day to day. Just like the other trading Greeks, Vega values will be positive or negative depending on the strategy being implemented, where the strategy strike price are in relation to the underlying price, and whether implied volatility is expanding or contracting. The key thing to remember that Vega is representative of extrinsic value changing, no intrinsic value. As the extrinsic value of an option tends to be higher the closer it is to the money, and Vega only affects the extrinsic value of an option, it stands to reason that this would be the case. As the extrinsic value of an option tends to be higher the closer it is to the money, and the Vega of course only affects the extrinsic value of an option. Understanding volatility, it is one of the most challenging option Greek concept, but also one of the most rewarding aspects of option trading. Learning how implied volatility impacts an overall option premium through Vega is a great place to start. The last option Greek that we're going to have a look, it is Rho. In this course, we will not pay much attention to rho, as only affects option with long-term durations. But rho represents the rate of change between an option value and a 1% change in the interest rate. As interest rate increase, the value of a call option will generally increase, while put options decrease. For this reason, call options have positive rho and put options have negative rho. For example, assume a call option that has a rho of 0.05 and a price of 1.25. If the interest rate rises by 1%, the value of the call option will be increasing to $1.30. For example, assume that a call option has a rho of 0.05 and a price trading at $1.25 at the moment. If interest rate rises by 1%, the value of the call option will be increasing from $1.25 all the way up to $1.30. Rho barely affects an option price, so much so that brokerage platform don't even include the option rho in the option chain. As you can see in the picture, it really doesn't have much effect on option price.